A volatility feedback loop is imminent, and it's going to crash the markets. I'm your host, Steven Van Metre, and thanks for joining me today. The safety mechanism built into trillions of dollars in equity strategies are on the edge of tripping, which would cause a massive selling of equities and a huge flight to safety that could send the stock market going straight down. And this happening at a time where the Federal Reserve is fighting inflation and can't come to the rescue. And what it threatens is a massive feedback loop that could send stocks to levels so low that it would shock most people. Let's pick this story up where we head over to the news, and I want you to understand that how people get this wrong because they don't understand what is going on in the underlying structures of the market. So let's start with this headline. The NASDAQ wraps its worst month in nearly 14 years as recession fears grow stronger. The tech-heavy NASDAQ fell 4.2% on Friday, dragged down by Amazon, which dropped nearly 15% after it missed earnings expectations. And I want you to keep in mind that when you think about Amazon's earnings and how they missed expectations, got a 15% drop, wait till earnings are actually bad. And you want to actually see how far stocks can go when these computer algorithms decide that they don't like the earnings report in after-hours trading. Just wait, because these earnings reports aren't that bad. And with the dollar rallying, they're going to get a lot worse in the quarters to come. But let's continue on, because the S&P shed about 3.6% on Friday, and Dow dropped about 2.8%. And the most closely watched inflation reading released on Friday, the core personal consumption expenditures price index, rose 5.2% from a year ago, spelling more trouble for the economy. An ever-growing number of headwinds are leaving investors unsure of what comes next. This earnings season has been lukewarm, and the U.S. gross domestic product dropped by 1.4%, falling well below analyst estimates of a 1% gain. The Federal Reserve has shifted to a hawkish stance, indicating it will increase the pace at which it raises interest rates next week. And Bank of America analysts, well, they said that the current 10% year-to-date decline in the S&P 500 can be very roughly interpreted as a discounting a one-third chance of recession. If the probability of recession rises, steep falls could continue. Well, how about this, Bank of America? Perhaps if the stock market goes down, then that means the wealth effect goes down, and that means a recession is likely, because when people lose money, they tend to spend less. And when they lose money, and a lot of it in a very rapid way, well, they tend to cut their spending very quickly. So let's say it's the other way around. So far the story sets up with, hey, the market's going down and we're not sure why. But now let's look at some headlines with volatility in it, and you can really get the picture of that nobody actually really understands this stuff. Earnings exacerbate stock market volatility whipped up by the Fed. As heightened volatility has gripped markets since mid-January, when the Federal Reserve's intentions to aggressively fight inflation became apparent. The central bank's first rate hike in 3 years sent treasuries into a tailspin and dented the appeal of stock market's biggest companies. War in Ukraine, renewed COVID lockdowns in China, the lingering threat of recession added to market headwinds, making it a risky prospect to see any rebound as the end of the turbulence. Again, all these different ideas of what could be causing this, and they have no idea what is about to come. And here you can see this notion that consumer price index leads to volatility. So I put the consumer price index in blue on a year-over-year rate of change against the VIX volatility index, and you can quickly see there's just about no relationship between the two. So the idea that inflation is triggering volatility, well, that's just not the case. And volatility, like we've seen in the past 4 months, doesn't come around very often, and that's why you see that when it spikes like this, sellers come in and try to short it to make a profit on it. And it's what has been done more lately, and perhaps the last 10 years, as a trade that actually is in lieu of owning bonds. So you see a lot of pension funds and a lot of large money managers and hedge funds that short volatility rather than holding bonds. And boy, that could end up blowing up big time, as you're about to see. But let's look at another thing, because here we see cross-asset volatility. So maybe there's something there, spikes all over the world on growth fears, and markets around the world are in the throes of volatility as growth fears in China. Again, China break out just as Wall Street grapples with ever more hawkish monetary policy in the age of elevated inflation. The prospect of shuttered cross-border supply chains, maybe that's it, caused by intensifying lockdowns in China, threatens a profound global economic recession. question. So the question is, what actually is going on? And let's look at the vol space, because this is where the problem begins, and you can see it. And I'll step you through. We're going to go back in history, and then I'm going to explain how these structured products work and how easily this is going to unwind if the genie gets out of the bottle, and this time it looks like she might. All right, let's take a look here at the VIX. This is the VIX Volatility Index, and you'll notice I've got some lines here between 31 and 36 on the VIX. So if you like to chart things, you might want to draw those on your chart, and you can see what I see. But I want you to look back now over the last 6 months, and you notice volatility got up into the 6-month range and got sold down. So this is where the sellers, this is what we refer to as vol sellers. This is their zone where they sell, and you see volatility comes up, they sell it, comes up, they struggle, sell it down, and all of a sudden it's back. But the problem is it's building up in this range. And this is an issue because not only is this a place where volatility sellers show up, it's also an area where these look-back mechanisms of many of these equity strategies look at for their safety mechanism to kick in. And the more hits you get in this range, well, the more likely those safety mechanisms are going to trip. But we'll get into that in a moment. But let's try to figure out, why is volatility rising? Does it has to do with any of those things in those articles? Well, I don't really think so. I think it has everything to do with the Fed. What does the Fed's quantitative tightening plan mean? Well, roughly 2 years after it launched the biggest and broadest monetary stimulus campaign in modern history, the Federal Reserve is in the process of withdrawing its support for the U.S. economy. And in this piece, they're referring to the tapering of QE. And a roadmap for quantitative tightening, as it's known, was released April 6. And the question is, what's relevant about April 6? Well, April 6 was 1 month after quantitative easing, fourth iteration, or I'm not sure which number it is, ended. In fact, it ended right here. And what we noticed is, now this starts to make sense, is that as the Fed tapered its asset purchases, volatility came back in the market. Now, why is that happening? Well, many years ago, Fed Chair Powell, before he was a Fed chair, but he was a member of the FOMC, he said in a closed-door meeting in the minutes that QE is a volatility suppressant, or at least that's what they believed it was, and that in itself is helping support equity prices. And if they ever undo QE, that it could cause a lot of selling in the equity market, or just a spike in volatility that could unwind those gains in the equity market. Well, how true is that? Well, let's take a look, because it's very true. And now we can go back to the end of QE3, which happened somewhere in this roughly circled area, and notice what happens afterwards. Volatility spikes again, the market gets control of it. And you have to remember, when QE3 ended, the economy was actually in a pretty good place, and there wasn't really much thought of why we needed QE3, but the Fed did it anyways. You get a little vol spike here, and all of a sudden it just completely unwinds. And how about when the Fed did QT, when they actually unwound their balance sheet? Well, that happened here in 2018. Or maybe it was late 2017, in late 2017, now that I think about it. And that for a while, the market said no big deal, and volatility was very low. And then all of a sudden, it just unwinds straight up. The market gets a hold of it, volatility is back, volatility gets back, volatility is coming back. And all of a sudden, you start to figure out that perhaps it is the Fed that's actually putting some underlying support, not directly in the equity market, but by suppressing volatility, which now makes you wonder, is this rally since March 2020 at the hand of all of that QE? Could this be explained by the Fed continuing to suppress volatility, and now without the Fed's volatility suppressant, that the market is about to go straight down because there's not enough money coming in? And you start to think about perhaps that in earning or wages due to inflation are negative, and people don't have the buying power to buy stocks that they used to. They don't have the fiscal stimulus, and you don't have the suppression effect of the Fed, who in fact is going to likely raise interest rates 50 basis points next week and announce that they're going to unwind the balance sheet, bringing even more volatility to the picture. And if that happens, well, that means we could be within a week of seeing this whole thing start to unwind. But is it just due to the Fed? Well, it also has to do with the consumer, because what did we see in the consumer sentiment survey from the University of Michigan? Well, you saw this. And U.S. sentiment actually crashed down to a level not seen since the bottom of the last recession in 2008 and 9, the great financial crisis. And even then, confidence stayed sort of low, but notice the equity market eventually followed it down. And as sentiment falls, equity markets go down. So even here, you're seeing sentiment start to tell us that the market is about to blow up. But there's one thing that shouldn't blow up when all this happens, and that's your portfolio. Be sure to check out Portfolio Shield. I'll put a link up there in the corner in the description below. Go back and look at how it did during the great financial crisis, and you'll see what I'm referring to. All right, let's take a look at the next piece here, because now let's come into the story of what is actually going on with these underlying structures. And so we look now back at the VIX, and we zoom out, and we start to see there's all of these spikes into this zone, and when it gets out of this zone, you'll notice it goes vertical, and it goes vertical really quickly. Because what happens out there is back starting in the year 2000, or actually in the late 90s, and then gained popularity in the early 2000s and gained even greater popularity after the great financial crisis, is the insurance industry actually started selling what are called volatility-linked or volatility-controlled products. And way these work, in fact, if you own a variable annuity or bought one in the past, say, 10 years or more, you might actually have this feature built into your strategy. And it's not just variable annuities, there's fixed annuities, there's managed strategies, there's tons of things that are linked to the VIX. And the idea is when the VIX gets out of control, I'll pass the look back mechanism. So these strategies look back over a period of time, and as the volatility rises, they start to go into safety mode. And if volatility gets out of control, they start going into, they just trigger and selling everything as fast as possible. And the idea being is if volatility goes up, stock prices go down, and all these strategies do is have to control that risk. And that's really simple. When volatility goes up, what do? You sell it. The faster it goes up, the more you sell, and it does it with a look back mechanism. So what we see now, and let's go back to this other slide, is in this picture here, and the data I'm going to give you does not even include this. In fact, the data I have is outdated because these companies don't release how much money is in these strategies, that perhaps all of these strategies went massively long, and some of them, in some cases, actually can leverage their position. So they get into 100% into equities, and they can even go beyond that. But when volatility gets out of control, they're formulas. So it's not someone like me or a manager that's sitting there that makes a decision. It is a formula that says, we hit these trigger points and we must sell. And when they sell, do you know where they go? They go to bonds. And why do they go there? Because bonds have now become a long volatility play. And what I want you to start to understand is this little logo here where it says Bond King. As you start to understand this, is perhaps has nothing to do with bonds, but bonds being a long vol asset class. And maybe that my view all along was that we were going to have another financial crisis. And when you understand how these products work and how they go from equities into bonds in a very rapid method, that perhaps all it is just a play on these structures causing the whole market to blow up. Because the best data we have, which is way outdated, says there's somewhere between $1 to $3 trillion in these strategies. And that number could even be as high as $5 trillion today, because it's how outdated that number actually is. And if you can imagine somewhere between $3 and $5 trillion starting to sell out of equities simultaneously and heading into the bond market, well, you get a spike in volatility, which causes a feedback loop, which causes those strategies to sell even more, and then floods into right now an illiquid bond market that causes it to go straight up. And so that's where you get this slide here, where you see when volatility rises, bond prices rise. And you can see bonds here are in purple. Volatility rises, bonds rise, vol rises, bonds rise, vol rises, bonds rise. Here's a point where they don't, and then bonds went up afterwards. Here's another point where they didn't. And then you see this rally in bonds had to do with the inverted yield curve. And then here you see this vol spike, and then you see bonds go straight up. And now everyone says no one's interested in bonds. Well, if volatility spikes and gets out of control, well, there's going to be trillions of dollars flooding into bonds, kicking off a feedback loop. Now, if you can only imagine what that would do to equities if trillions of dollars started selling, and some of these products sell overnight when we can't trade. It makes it pretty interesting to see that the Fed now is not in a position to bail out these strategies or these investors, because they've got to fight inflation now. Give you something to think about. And this could happen at any moment, because as we just saw, volatility is hitting the last 3 months or 6 months in that zone. And these algorithms will be itching to sell as soon as it gets out of hand. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.